a mutual fund, an ETF, an index fund, or even a hedge fund. At their core, they're all pools of investor capital, professionally managed to pursue a particular objective. Instead of buying individual stocks or bonds one by one, you invest in a single fund, which holds dozens, hundreds, or even thousands of underlying securities. That gives you instant diversification, professional management, and, depending on the structure, access to strategies you might struggle to implement on your own. But not all funds are created equal. Today, we'll break down the differences between mutual funds, index funds, ETFs, and hedge funds, how they work, how they're managed, the risks and fees you'll face, and which type of investor they suit best. Welcome back to the Trade Savvy Academy. Don't forget to follow me on X for my live trade alerts at the handle shown on the screen. First up, the classic mutual fund. A mutual fund issues shares that investors buy directly from the fund company and redeem back to it. Typically, a professional portfolio manager chooses individual securities, stocks, bonds, or both, aligned with the fund's stated goal. If it's a growth mutual fund, the manager might pick high-potential tech names. If it's a bond fund, they'll select an array of corporate or government debt. You get daily pricing. The fund calculates its net asset value after markets close, and that net asset value per share is the price you'll pay or receive. Mutual funds can be actively managed or passively managed. In an actively managed mutual fund, the manager is constantly buying and selling, attempting to outperform a benchmark index like the S&P 500. That expertise comes at a cost. Actively managed mutual funds typically charge expense ratios between 0.5% and 1.5% per year, and sometimes even higher. Plus, some carry sales loads or redemption fees. The hope is that the manager's skill will more than offset those fees. History shows some managers do, but many underperform their benchmarks after fees. Contrast that with a passive mutual fund, also known as an index mutual fund. These funds simply buy and hold every security in a given index in the same proportions. If you want the performance of the S&P 500, you could buy the S&P 500 Index Fund, and the manager will mirror that index precisely. Because there's minimal trading and no high-priced research teams to pay, expense ratios are extremely low, often between 0.02% and 0.10%. And yet, over the long run, passive index funds frequently outperform the average active manager simply by avoiding high fees and trading costs. Next, exchange-traded funds, or ETFs. ETFs can be either passive or active, but they trade on an exchange just like a stock. That allows real-time intraday pricing. You can buy or sell throughout the trading day at market prices that may differ slightly from the net asset value. Most ETFs today are passive, tracking broad indexes like the MSCI World Index, the NASDAQ 100, or a bond benchmark. Their expense ratios are comparable to index funds, often in the 0.03% to 0.20% range. The ETF structure offers some advantages. Because they trade on an exchange, you have the flexibility to use limit orders, buy on margin, or even sell short. Bid-ask spreads can be tiny for the largest ETFs, keeping trading costs low. However, smaller or more exotic ETFs may have wider spreads, and occasionally, the market price deviates meaningfully from the net asset value. ETFs also typically distribute capital gains less frequently than mutual funds, which can make them more tax-efficient in taxable accounts. If you're finding this breakdown helpful, don't forget to hit the like button, subscribe for more insights on building wealth, and ring the notification bell so you never miss an update. Now to the heavyweight, hedge funds. Hedge funds are available only to accredited investors, individuals or institutions with high net worth or income. They employ a vast array of strategies: long-short equity, market neutral, global macro, arbitrage, and more, often using leverage, derivatives, and short selling to boost returns or profit from market dislocations. In theory, hedge funds can outperform public benchmarks in both up and down markets. That potential comes at a very high cost. The traditional 2 and 20 fee structure means investors pay a 2% management fee on assets and 20% of any profits above a hurdle rate. Performance fees align incentives but can eat into your returns significantly. Hedge funds also impose lockup periods, meaning your capital may be tied up for months or years, and notice periods for redemptions. Their risk profile varies widely. Some funds aim for steady, low volatility returns, while others swing for the fences with concentrated bets and high leverage. So how do you choose among these four vehicles? It boils down to your goals, your risk tolerance, your time horizon, and your willingness to pay for active management. If you're a long-term retirement investor seeking broad market exposure at the lowest possible cost, index funds or passive ETFs usually win. They deliver market returns minus a sliver of fees, with minimal trading friction and strong tax efficiency. If you believe in a manager's ability to beat the market, perhaps someone with a stellar multi-decade track record, you might consider an actively managed mutual fund or an actively managed ETF. Be sure to examine not just past performance but also consistency, fee structure, and how the fund performed in market downturns. Remember that high fees can erase performance advantages, so look for a manager who has delivered alpha net of fees over full market cycles, not just during bull runs. For sophisticated investors with high risk tolerance, access to accredited capital, and a desire for absolute returns, hedge funds offer strategies you can't replicate in public markets. But be mindful of the fees, the lockups, and the opaque reporting. Conduct thorough due diligence. Review the fund's strategy, historical volatility, correlation to broader markets, counterparty risk, and of course, the operational robustness of the management firm.
Let's summarize key points in simple terms. Mutual funds, bought and sold at end-of-day net asset value, active or passive, moderate fees, open to all investors. Index funds, a subset of mutual funds, passive, track and index, ultra-low fees, broad market exposure. ETFs, trade intraday like stocks, mostly passive but increasingly active, very low fees, flexible trading tools, tax efficient. Hedge funds, private, accredited only, complex strategies, high fees, potential for uncorrelated returns, illiquid. When it comes to risk, all funds carry market risk, the chance of losing money if markets fall. Actively managed vehicles introduce manager risk, the possibility that the manager's bets underperform. Hedge funds add leverage risk, borrowed money, magnifying both gains and losses. Liquidity risk arises in mutual funds and ETFs if market stress widens bid-ask spreads, or when forced redemptions force managers to sell assets at a discount. Fees deserve special attention. Even a seemingly small difference, say 0.1% versus 0.5%, can erase tens or hundreds of thousands of dollars over decades of compounding. Always compare expense ratios, sales loads, redemption fees, and performance fees. Aim to understand exactly what you'll pay in different market environments. Finally, think about taxes. Mutual funds can pass through capital gains annually, triggering taxable events in your account even if you didn't sell. ETFs tend to be more tax efficient because of their in-kind creation and redemption process, which helps avoid forced sales. Hedge funds may generate complex tax filings and require careful planning with your CPA. In the end, most individual investors will find that a core of low-cost index funds or ETFs forms the backbone of a resilient portfolio. Active mutual funds might make up a smaller satellite allocation if you have conviction in a specific manager. Hedge funds generally remain the domain of well-heeled institutions, family offices, or high-net-worth individuals looking for specific alternative strategies. Whichever path you choose, clarity of purpose is paramount. Know why you're investing, what you expect to achieve, and how much risk you can tolerate. Read each fund's prospectus or offering memorandum carefully. Watch for hidden fees or overly complex structures that mask true costs. And remember that long-term success in investing rarely hinges on timing the market. It rests on diversification, discipline, and keeping costs as low as possible. Thanks for watching. If you found this breakdown helpful, don't forget to hit the like button, subscribe for more insights on building wealth, and ring the notification bell so you never miss an update. If you have questions about specific funds you're considering, drop them in the comments below, and I'll see you in the next video.